is designed once a month to be an open hour with experts in and around compliance. We've got Gordon, Goldie here, and Paul Saint-Pierre. Guys, would you like to just maybe do a really brief intro what you do and what this
Sure.
compliance zone is all about? Paul, you are the strategic navigator of those conversations.
Sure. It's Monday, December 6th. We've a couple more days before the end of the year. My name is Paul Saint-Pierre. I'm principal of my own firm, PSP Advisors, which provides, it's both an RIA, a registered investment advisor, helping investors navigate alternative investments, including real estate, private equity, business development companies, etc. And for the past couple of years, I've been up to my eyeballs, getting very, very familiar in the application of the Opportunity Zone rules and regulations, and certainly trying to figure out very creative ways to use these regulations for the benefit of successful businesses. We have two co-hosts. We have Gordon Goldie here, who's going to speak for himself in a few minutes, and we have another co-host, Brett Siglin, who is likely to join about halfway through the call. But Gordon, why don't you give a snap profile of your credentials and your love for Opportunity Zone regulation?
Yes. Thanks, Paul. So I'm a CPA. I am with Plant Moran, public accounting firm, primarily based in the Midwest. I'm based in the Detroit area. We have also offices in Illinois, Ohio, and Colorado. But we have clients in every state, and we do transactions in every state. So I for about almost 20 years now, I've been focusing on assisting clients with community development type projects that utilize tax incentives, and primarily federal historic tax credit and the federal new markets tax credit. And when the Opportunity Zone program came into the statute, a lot of the same clients that I worked with on those incentives were interested in the Opportunity Zone, and so dug into it quite heavily. And I've probably been spending about half my time working with clients that are utilizing the Opportunity Zone incentive, on a variety of types of transactions, including a lot of real estate and some operating businesses.
Well, thank you for that, Gordon. And I am working with Gordon on some other projects, and Gordon is very, very detailed. Nothing. He doesn't miss anything, and he's a real trooper to really, really apply the regulations word for word and really get into the weeds on that stuff. The slogan of this group is the purpose of this group is to provide compliance guidance for successful Opportunity Zone investment strategies with a strong foundation of twining the Internal Revenue Code Section 1400Z, rules, regulations, and IRS guidance, and to twine that with other Opportunity Zone related federal tax law matters and federal securities laws. And so it's not just tax, but we do, stick our toes into federal security laws, because that is another significant regulator that is paying attention. We're set up to take Q&A, questions and answers, from our membership here. We certainly want to, if you're hearing anything on the street, any hearsay or reading anything that sort of crinkles your eyebrows, we certainly want to hear about that. If you're hearing stuff that certainly needs a clarification, either in readings or anywhere else. And if you're hearing about any IRS actions or regulatory activities, then we certainly want to hear about that. So today is December 6th, and December 31st, 2021 is the last date for investors to invest in any qualified opportunity fund and be eligible for a 10% step up in the investment tax cost basis before the computation of recognized gains in tax year 2026 after the required 5-year deferral after a 5-year deferral of capital gains. So that's December 31 this year to December 31 of 2026 gets you to 5 years. Keep in mind, I get a lot of emails on this stuff. I'm sure some of you do. Some of it is misworded or not entirely accurate, but keep in mind that this is not a 10% reduction in tax liability. Capital gain tax rates may be higher or lower in tax year 2026. And the actual tax rate savings is determined by the marginal tax rates after considering all other sources of long-term capital gains and ordinary income related to short-term gains that are experienced by the individual taxpayer. So there's a lot of emails on this stuff that could be confusing, but it's important to understand that this tax benefit is computed in the context of future tax facts and circumstances, and the tax benefit is unique to each QOF investor. So for example, if an investor is deferring $1 million of capital gain this year, their tax basis in the Opportunity Zone Fund is $0. $0 is their tax basis. What this code section allows you to do is to increase the tax basis from $0 to $100,000 before computing the recognition of capital gains in tax year 2026. So therefore, instead of $1 million deferred gain that's being taxed in 2026, it's now only $900,000, provided you hold your investment in the Qualified Opportunity Fund for the entire 5 years. So I just wanted to make that clarification, because there's a lot of, the way things are worded means a lot, and I care the way that things are worded and how it's clearly understood. So there's a lot of people pounding the drum on that stuff. So with that, let's open up, let's hear your thoughts. Let's hear any questions you have or anything you're hearing on the street, any puzzling matters. And so let's go.
This is Bill Newton. I'll go first.
Thank you, Bill. Welcome.
Thank you. Working with a couple CPA firms for the last year when we put a couple of these opportunity zones in place, and they didn't have the foggiest idea how to do it. So it was a learning experience for them. But my question is just to clarify, for capital gains that say are recognized in December of this year, they have 180 days in order to defer them into a qualified opportunity zone. So if we implement the QOZ, say March of next year, they can be retroactive back into 2021. Is that correct?
It could be retroactive. So let's say that the investor wants to invest in the QOF on March 31st. You can go backwards 180 days into 2021. So any capital gains, short-term or long-term gains, that occurred in the prior 180 days can be tagged as deferral and invested in that fund as of March 31st. Keep in mind that some capital gains, like partnerships, can be recognized either at the event of the capital gains event, or it can be recognized at the last day of the year, or it can be recognized on the normal regular tax filing date of that partnership. So partnerships, you have a lot of latitude in terms of choosing the recognition date. Things like 1099 dividends and things like that are end of the year. So depending on the nature of the capital gains, it's going to be tagged either as of the date of the occurrence or the end of the year or the tax filing date. But you are right. So if the gain is actually treated as recognized on December 31st, then you add 180 days, and I think you get to June 27th of 2022 to write that check, wire that money into an Opportunity Zone fund. So Gordon, can you amplify on any of that?
Yeah, but they wouldn't be entitled to that 10% step up, would they?
Right, yeah, I was just gonna
No.
clarify that, right, the 10% step up is based on the date you contribute the money to the kickoff, not the date of the gain event, so you wouldn't, you can do it retroactively, but it doesn't qualify for the 10% if it's.
Right, okay, thanks.
You know, we just might add that if you just do the math and the example I gave you, if you're deferring $1 million of capital gains and the step up is $100,000, then you would just multiply that by the investor's marginal tax rate, distinguishing whether it's long-term or short-term capital gains, and that's really the amount of the savings. But in most models, the big bang is the freak, no taxation of capital gains after 10 years. This little 10% step up does not really contribute very much, very insignificant contribution to after-tax returns, okay? So while there's a lot of hype around it, it's not a very big deal. The investors aren't really giving up very much. And I'm very concerned about it because the more hype there is around the end of the year getting now, it's like, well, what are we going to talk about for the next 5 years?
Yeah, one thing I'll mention that we've had some discussion with people about is just the timing of you know, some of these 180-day periods and the trying to get the 10% you know, additional incentive. And so if you look at the calendar, December 31st is on a Friday, which is normally a banking day. However, I honestly don't know if all banks are open that day or if you're able to make wires. And so, you know, we've had a number of situations where people are expecting to have the first day of their 180-day period be December 31st because it's coming through from a K1, for example, and they're planning on making their investments on December 31st. But I'm telling them, well, you know, make sure your bank's going to be able to do wires that day because I don't know if that's going to be a holiday or not. So, and I don't know if there's a universal answer to that, but it's something to pay attention to.
Well, and on December 31st of this year, you may not even know all of the sources of your capital gains unless you're really on top of it with your brokerage statements, your alternative investments. I mean, but K1s are not even in hand on December 31st. So if investors could estimate it, they can always invest money into an opportunity zone fund on December 30th or December 31st in anticipation of capital gains, but then it would be trued up based on the actual capital gains. So some of their investment would be allocated to the preferred tax position. And if they invested too much, then some of it would just be ordinarily taxable and not be eligible for special treatment. But it's going to be tricky in terms of how much are investors really on top of their capital gains picture to the last day of the year. But it just takes careful planning. And as you said, the CPAs really set up to deal with it in this sort of tight situation. Okay. Bill, you want to share any comments about how you experienced where CPAs are just not ready for opportunity zones, or you just want to keep that to
Sure.
yourself?
No, we have a CPA firm that works with our clients because we do their tax planning for them, and they're regular, I'd say 700-800 returns, and we were the first ones that brought them opportunity zones. And then my personal CPA, who's very heavy with business owners, once again, he was not familiar, and so I told him to check with this other CPA firm to do that. And once again, as many as you might be aware, and maybe even Gordon, it sounds like you're very proactive with your clients, but we encounter CPAs who are not very proactive, with their current client base. And so it just kind of was interesting. So we were the first ones that brought them the actual opportunity zone investment. Yeah,
I mean, it'd be nice to see opportunity zones as a continuing education topic for the whole CPA industry over and over and over again. But I'm sure there's many professionals trying to make that happen.
Would be nice. It would be nice to see this 2026 extended for many years down the road.
Well, we can set our intention and see how that works out with Congress.
And Gordon has a crystal ball, so he can tell you all about it, right?
Yeah, my crystal ball says that tax programs don't get extended until they expire, and so I wouldn't count on anything getting extended until 2026. But my crystal ball is not perfect though.
This is perfect time for the disclaimer too.
Yes.
Yeah. Good morning, everybody. Paul and Gordon, everybody, thank you so much. This is fun. My first attendance here in the compliance zone, and I have a question about. I'm getting a lot of talk about uncertainty in 2026, and people are saying, well, are we paying 20 or 23.x% at today's capital gain rates in 2026, or is it a kind of a wild card because we don't know what the rates will be in 2026? What rates will these gains be subject to at that time?
Gordon, you want to give the clear answer? Thank you, Gordon.
Yeah, well,
Thank you, Lauren.
The clear part of the answer is it'll be that when the income gets recognized on December 31, 2026, it'll be taxed at whatever the current rates are at that time for the type of gain that you deferred. So if you deferred a short-term capital gain, it'll be taxed on whatever the rates are for short-term capital gains at that point. If you deferred a long-term capital gain, it'll be taxed at whatever the long-term capital gain rates are at that point. The unclear part of the answer is what will those rates be? As you know, there's been some proposals to increase capital gains rates, although at this point it doesn't look like that's likely to happen anytime real soon. The legislation that it was part of, it's been dropped from that legislation. So, maybe we might have dodged a bullet from that standpoint. But, the odd thing is that to the extent that the rates go up, it does make opportunity zones more attractive, because the gain that you'd be excluding after a 10-year sale is going to be taxed at a higher rate if the rates do go up. And so it makes it even more valuable to use the opportunity zone program. It's just for those people who already have gains that that already paid tax at or would have paid tax at a lower rate had they not deferred. Those people end up not getting as big of a benefit because they're going to end up having a bit of a whipsaw on the if there is an increase in rates. But for anybody that would have a gain after the rates increase, the opportunity zone program would be better, because the benefit of the exclusion after 10 years would be greater.
Yeah, no matter what, right? So my understanding is that, okay, so if we invest into an opportunity zone fund or disperse our capital gains into an opportunity zone fund, and let's just say we're subject to, what's the long-term capital gain rate, 23.8?
Right, with the net investment income tax, it's 20.
Okay, so in 2026, we'll be subject to 23.8%, is what you're saying.
Right, if the rates don't change, right, exactly.
If the rates don't change. So let's
Right.
just say next administration comes in and says, we're going to raise capital gains to 38%. Is that gain that we supposedly got before December 31st of this year going to be subject to 38% now, or is it going to stay at the 23? So there's a wild card there.
Yes,
You're taking a big chance.
yes.
But I just want, like in my opening comments, you're subject to the marginal tax rate. And I associate the deferred tax element to a future liability. It's a future financial liability, just like a loan. It's a term loan. The Treasury saying, don't pay me now, pay me later. And to the extent that in the financial tax planning for the client, to the extent that they are aware of that future recognition of a tax liability, they can possibly manage against it. They can harvest tax losses. They could delay the recognition of other capital gains. And, they could possibly get their tax rate down to 0 with proper tax planning and proper tax management.
Mhm.
They could stop working in 2026 and not have any income, and perhaps assign a 0 to short-term capital gain. So it all depends on the taxpayer's unique situation and how well they're managing their total tax picture, not just their opportunity zone tax picture. Okay.
Mhm. Oh yeah, of course, yeah, yeah. But it's not everybody thinks as sophisticatedly as CPAs and tax attorneys.
Yeah.
So I get these questions a lot. In fact, I was on a panel last week, and this question came up, and it was one of these things where an investor had $10 million to put into a fund, or had $10 million gain, and considered OZ funds, but he didn't like the uncertainty of what the rate might be in 2026. So he just said, no, I don't want to do opportunity zone funds.
Well, I mean, when I hear that from investors, I say, okay, just go write your check to the U.S. Treasury today. If people want to write their check to the U.S. Treasury, don't get between them and the U.S. Treasury. Just let them write their check.
Exactly.
You're never going to be able to convince them to delay the tax recognition. So,
Right.
This is for investors that understand that deferral has value, and deferral could be managed down to 0 with a whole lot of other tax strategies. Who knows what deferral mechanisms are going to be available in 2026? There are other ways to defer taxes downstream. So it's not black and white, okay? But if they're happy to write checks to the U.S. Treasury, I'm sure the U.S. taxpayers would be happy for people to pay their taxes.
Oh, absolutely. Yeah. Oh, yeah. We're all going to have our epitaph saying we've contributed our fair share.
Yeah. We paid our share. Yeah. Okay. Did you have a follow-up? Did you have a follow-up question?
No. Well, I have a couple other questions, but I want to see what other people are going to ask as well.
All right. Well, let's hear from some of the others members today. Please state your name and the question.
Hey, Paul, if I could chime in real quick before we take the next question, I just wanted to make sure that everybody knows, especially some of the folks who are new here, that inside of the OZworks group platform, if you go on the navigation, you can actually go to groups, and there's a compliance zone to opt into. And so if you think of something after the fact, or you're just shy, which is fine, and you want to ask it in a different format, you can go into that group. You just have to opt in. It's included in everyone's membership, but there's a specific area just for compliance questions. There's kind of some spillover, as we've seen with like the Puerto Rico zone and different things like that. But Paul and Gordon and Brett are all available there. You can tag them, and if I see it, I'll tag them. But we can certainly field questions that way as well. So if you think of something after, that's the place to do it.
I just want to add that that the IRS has several pages for opportunity zones, and they also have Q&A, sort of Oz 101 Q&A there that can answer some of the more simplified questions as well. Okay.
Yeah, and there's also a search feature within those groups. There is all across the entire platform, and when we post the replays of past sessions like this, I make it a point to kind of identify some of the topics that were covered. So if you have something in mind, you may even want to search. We've put a couple of the questions that came up in previous sessions as well. So there's a repository there of questions that may even have the answers you're looking for right away. So you can do a little search up in the top bar. Paul, there is I got a direct message just asking if you could kind of reiterate or relate, dive in a little deeper in reference to the single LLC fund and businesses that you were mentioning.
Sure. Thank you. Thank you for asking for a repeat of that. So under the section 1400Z regulations, it allows 3 alternative recognition dates for the capital gain. The first one can be the actual date when the partnership sold an asset and recognized a gain. So that might be, for example, September 15th, okay? Alternatively, it allows the taxpayer to recognize that gain coming through the K-1 as of the last day of the tax year. So that's option 2, December 31st. And the third alternative for recognition is the normal regular tax return filing date for the partnership. So I think, Gordon, that would be, say, for example, March 15th of 2022.
Yeah,
Looking
the only thing
forward.
I'd just add to that is that that assumes a calendar year. Most pass-through into these are a calendar year, but the one exception would be if the partnership liquidated. So like if the partnership sold their assets in September and liquidated in October, then the year end of the partnership would be the date it liquidated in October instead of December 31. And the final tax return would be due in like January instead of March. So you do get a different answer if the partnership liquidated during the year of the sale. But assuming they don't liquidate in the year of the sale, then it would be December 31 and March 15.
Good call. So next time I answer the question, it's going to be four alternatives.
Thanks, Paul. Thanks for that.
So go ahead. Do we have another question
Well,
from the audience?
it's on what you were discussing, and this is Mary, and I'm new to all of it. So it could be a dumb question, or it could not be a dumb question.
Welcome, Mary. We love to hear from you.
Yeah, don't shoot this messenger. With what you just said about the single LLC, with our capital gain took place on May 28th of 21, and we established our fund, with the bank, and the money went directly from the closing into the fund. And we also have a business account set up that we are going to transfer into the business at that 90% before the 31st, and then start our development in December maybe, but it looks like it'll probably be January with everything that's taken place. Does the 10% that you're talking about, does that apply to us in any way? Does that come in at the end? We planned, because ours is an individual, to hold it for the 10 years.
The 10% step up in basis. Okay. All investments in opportunity zone funds come into the $0 tax cost basis. And that 10% step up would be applicable in tax year 2026, provided you hold it for 5 years or more, okay? So you got to be a holder on December 31st, 2026 to get that step up in basis, because that deferred capital gains is going to be recognized for taxation purposes in tax year 2026. So it does apply to you as an investor in a fund, yes.
So if we held it for 10 years, you have to be recognized at 5 years and then at 10 years?
There's two events. First, there's the recognition of taxation in 2026 on the deferred element. I call that the deferred element taxation. The second piece, 10 years, is your investment in the fund is tax-free if you hold your investment interest for more than 10 years. So there's two different taxation events.
Okay.
One's on the deferral, and the other is on the long investment in the fund.
Okay. Thank you.
Mary, thank you for chiming in and for being here. There are no dumb questions. Part of the intention here is to create an incredible mixture of knowledge bases. And Paul will be the first to tell you, and Gordon as well. We decided not to have a broken up, 101 course, 201 course, advanced, intermediate. We wanted to mix everyone together because there's always an opportunity to learn from each other. And so I really appreciate you reaching out and asking, because it's also good as a recap for a lot of people too. So
Yeah.
thank you for that.
Well, you're welcome.
Did that clarify the question for you?
Well, for now it does. You know, I have a multitude of questions, but I'm working through those, and Ashley's working with me. So I'm getting better. We've been involved with 1031s in the past, and when this came about, we were not happy with what took place with 1031s. So I was looking for another avenue and lucked into one of y'all's presentations, and now this train's running. So I think a lot of people need to know. And in my little area, nobody knows. So not even our governor. So we're educating
what little
everybody.
area are you talking about?
Well, actually, Opportunity Zone sits on Governor Abbott's desk in Texas, but all of the planning and development people in our area, which is Huntsville, Texas, have never heard of Opportunity Zone. Small Business Administration, you know, anybody that you would normally reach out to get information. So we're passing along that education, and I'm sure that you guys will be hearing from them quite a bit, because we're just real fortunate with where we are, and most of our area is Opportunity Zone for different things, because ours is a single, you know, it's just my husband and I are in our LLC, and we're doing this for long range investment for our children kind of thing, that will pass along. So we're just trying to get everything all set up, and we are developing an RV park, which a lot of people are doing, and there we are. So I hope the IRS doesn't bite us in the rears. I keep getting nervous every time Biden says he's hiring more agents so that he can do a money grab, and our particular accountant, who we've had for 30 years, had never heard of Opportunity Zone. And we've been educating them on what we've been learning. And they're in an IRS meeting now with agents where they're being told that the IRS is suing civil suits towards persons with Schedule Cs. So I'm assuming that's DBAs underneath their, whatever their name is or whatever, doing, you know, but I don't know. All I know is she says they're doing it. I don't know. It doesn't apply to us. So I'm not fortunately being sued there or anywhere else that I'm aware of. But I just threw that out there because y'all may already know that, or you may not want to know, or you may not even get involved in that, whatever.
Well, Mary, I will say, OZworks group, you know, as much as we can be helpful and supportive, please feel free to relay to, you know, the whole community of Huntsville. I know John Vachon is here, and there was some knowledge curve in the town of Kingsport where he's been doing a lot of work, and John has been a champion in educating. So you may be that person in your area too. I would recommend maybe even connecting with John. But
I would like to.
Yeah, we set up OZworks group as a QOZB, and personally, you know, I've taken my capital gains and invested them into QOF, and so, you know, we are truly a practice what you preach kind of organization. And I will say that I ultimately had the same types of conversations with my CPA and went to find a new CPA. So hey, that's just, and I found one through this group when we first formed it. So anyway, I hope that we can certainly answer your questions and keep them coming as you think of more. I see John just put his contact information in the chat there. So
thank you.
John's okay with connecting with you there. And there are some members of the community that are also utilizing the trailer park model. And Mary, if you're already working with Ashley, I'm sure you already know about that. And Robbie Krager, who's doing that actually in Puerto Rico. We visited his site on one of our in-person events last June, and it was great. I mean, talk about a beautiful location to have an OZ trailer park, like right on the ocean in Puerto Rico, where we had lunch and, enjoyed the surf. So anyway, sorry to hijack the conversation.
Oh, no, but thank you. And I'll get unmute and listen because it's very informative. Thank you.
Wonderful, wonderful.
All right, well, let's keep the questions coming in. Please propose your question, state your name. Let's hear what's on your mind.
I'll go again.
Thank you.
So let's say there's a situation where an investor invests into an opportunity zone fund. It's in a we'll use real estate because that's what I'm involved with. And in 5 years, a project stabilizes and there's enough money there to give the investors all of their principal back, and plus they hit the waterfall and whatnot, and the project sells at say year 5, and those investors get all their money basically on a debt, right? They have to get the money on a debt thing to continue to keep their status as an OZ investor. Is that right?
I'm going to let Gordon handle this one because that gets pretty complicated. Go ahead, Gordon. Please help me out on this.
You're talking about like a single property investment?
Yeah. Let's just say it's a single asset fund, and the sponsors end up getting a great offer in year 4 or 5, whatever, after stabilization, and they decide to sell that asset. And so what is the best approach for the sponsors to handle that in terms of keeping the OZ incentives alive for their OZ investors?
Yeah, I mean, there's not a one size fits all answer, but there are some options. So, for example, you potentially could do a 1031 exchange at the qualified business level. So, you'd have to. It would be complicated because the replacement property would have to be qualified opportunity zone business property, and that may mean doing a reverse exchange. And I don't want to get into real technical details of the 1031 program, but it wouldn't be necessarily an easy 1031 exchange. Like one of the big differences between an opportunity zone 1031 exchange and a regular 1031 exchange is that opportunity zones, the property either has to have been new construction or substantial improvement, whereas regular 1031 exchanges don't have that requirement. And so in order to do a 1031 exchange where there's substantial improvement or new construction, it just complicates things. And so, but it's at least worth looking at, because if you're able to make it work, where you do a reverse exchange, or you're going to be investing a lot more money into the new property, you might be able to make it work. And so that would be a way to cash out and still kind of keep the ball in the air with respect to opportunity zones, because that, any gain from that sale, and at year 5 or whenever the sale occurs, when they get the offer they can't refuse, would get rolled into basically the replacement property, and you'd have a reduced basis, or the qualified business would have a reduced basis in the replacement property. And if let's say you fast forward another 5 years and then sell the replacement property, that they're to the point where you're past the 10-year investment period of your initial investment, then you wouldn't have to pay any tax on that. And so you'd ultimately be able to exclude that gain on the interim sale at year 5 by doing a 1031 exchange and then waiting another 5 years to until you have your sale of the replacement property. And that's probably the best case scenario in terms of how to handle it, but it won't be easy to be able to do a 1031 exchange at that point. And obviously the replacement property would also have to be in an opportunity zone too. If you did a 1031 exchange, but it wasn't into opportunity zone business property, then, I guess at that point, you could still have a fund, but it would be subject to penalties because it wouldn't satisfy the 90% test. And so for example, I guess there might be a scenario where, like 9 years in, you'd say you get a offer you can't refuse, you sell at that point, and you maybe there's a way to to just pay penalties for a year until until the 10 years is up or something. But most of the time you'd want to make sure you satisfy the replacement requirement in order to make that work. Otherwise, you're going to end up paying tax on that gain, at the time of the sale, and it's and that'll if it's before the end of 2026, you'll have the ability to reinvest that into another opportunity fund but that would start a new 10-year clock. So
You have to do that within 12 months too. Is Brett.
well, within 180 days, I guess you'd have to reinvest, right?
You have 12 months. Yeah, that was in the final regs.
Oh yeah, okay. So if you're
You
saying
don't need to do a 1031 exchange either.
right. If the qualified business wants to reinvest, they can reinvest into into another property, but you
An opportunity zone property, it would have to be.
right.
Okay. Yeah,
Right,
without
so-
doing a 1031 exchange.
Yeah, you don't have
Right.
to include a 1031 as long as the replacement property is in an O zone and you satisfy all the other requirements. But I think what Gordon says is absolutely right. Then you restart the 10-year clock, right?
Well, not in that scenario. So just to be clear, if you want to defer the gain on the interim sale, there's two ways to do it. One would be to do a 1031 exchange at the qualified business level, but the complication is the replacement property has to be qualified opportunities on business property. The other would be to have the gain flow out to the individual investors, and then have them reinvest it into another opportunity fund. But you can't do that after December 31, 2026. Actually, you could probably do it up till as late as
Till
September.
2028, isn't it? I think they have
It's
until
up September 11th to 27. I think is probably the latest you could invest into an opportunity fund. But in that scenario, you'd have to invest within 180 days of the gain, and you'd get to defer it. But I guess you'd have to recognize it right away anyway, right? If it's in 2026, because you have to pay tax at 26. So there's probably not much of an opportunity there. It's more if there was a sale, say in 2023 or 2024, that it could be beneficial because then you could defer it for a couple of years. But at least the replacement property would be eligible for the 10-year, exclusion out, but you'd start a new clock in that scenario.
Right.
If all you wanted to do is get opportunity zone benefits on the replacement property, you weren't looking to defer the gain on the interim sale, then you have a year to reinvest. The qualified business has a year to reinvest into replacement property, and that would qualify. The replacement property would qualify, but you'd still have to pay tax on the interim gain. So that's kind of the downside of that approach, is that there's no, you do have to pay tax on that interim gain.
That's right.
Got it. Okay.
All right. And I just might add
I
that
was just gonna say, if you're talking about
there's even tax
as opposed to real estate.
Okay, hold on, Paul, go ahead.
No, let Gordon finish.
Gordon, finish.
Yeah, I was just gonna say, if the investment that the opportunity fund made is into a business and not a real estate, there is a structure that you can use called qualified small business stock, section 1202, qualified small business stock. That currently allows for an exclusion of gain on subject to limits if the investment's been held for 5 years. So, but it's not available for real estate. So if an opportunity fund invests into a business that's set up to qualify as a section 1202 small business stock, they can sell that business with it between year 5 and year 10 and get an exclusion. But the exclusion is not under the opportunity zone rules, it's under these qualified small business stock rules. So those two programs can be layered together. So again, if you're investing into small businesses, it may be possible to shorten your time horizon for holding periods to 5 years, and still have the opportunity zone layered in there in case the holding period goes to 10 years.
Mm-hmm. So if it's let's just say it's a real estate fund, it's a QOF, and it's real estate. Is there anything you need to do? You brought up a good point. All of a sudden I thought of another question. Is there anything you need to do, present or redo in the fund or amend the documents in order to be able to invest into a QOZB? at that time?
So are you saying that the fund owns the real estate and they
So
sell?
let's just say it's a real estate fund that
Uh-huh.
sold a piece of property, and now it has this gain that you're saying can be reinvested into a business possibly rather than real estate.
Is it a
Mhm.
single asset fund?
Yeah, I'm just saying a single asset fund. We're just going with
Yeah,
a single asset
Yeah,
fund
so
for
I
now.
mean, you would definitely want to update your offering, memorandum to disclose that to investors. I mean, it just depends on what you put up front. And a good lawyer will give you lots of flexibility so that there is that contemplation at the front end that there might be a sale at some point, between year 5 and 10. And then if there is, the sponsor would have the flexibility to decide how and when to reinvest. So it just,
Mhm.
it depends on what's in your upfront docs, what needs to be updated.
Okay, good.
There is,
I was just going to say, for the interest of disclosure, what Gordon mentioned about the 1031 exchange could be risky because we don't know how long the 1031 exchange for real estate is going to remain in the tax code. So even that may not be available in several years. We just don't know. Okay.
Yeah, that's a wild card all the time, but haven't they been talking about getting that out of there since its inception?
Well, in
Like, what was
2017,
that, in the
they almost
30s or
did
something?
they almost did get rid of it 4 years ago. It was saved, but it was watered down considerably with the passage of this incentive.
hey, Brett, if I could use this opportunity, I know you, thanks for popping in. Do you want to just give everyone a really quick overview of your background expertise and where you stand right now?
Absolutely. Thanks, Chris. Sorry I was late. We're in the middle of the fourth quarter and got about 25 deals going on, but really glad to be part of this compliance group. We've been doing this for a few months. I'm Brett Siglin. I'm with Jennings, Strauss & Salmon. We're in downtown Phoenix, Arizona, and we've been all over this for the last 3 years, working with sponsors, developers, investors, lenders, and others, setting up QOFs, navigating the rules, and getting their QOZBs in place. So nice to see you all this morning.
Thanks as always for being here, Brett. Appreciate you, man. One question that came in, Paul, I guess I'll start with you, or you can defer if you'd like. Mary was asking, how much do you have to leave in your fund after you drop it into a business? Your 1% contribution, does it go into fund account or business account? And Mary, if you want to clarify, please feel free, or if that needs clarification.
Yeah, please provide a clarification on that.
Mary, can you you're on mute right now, but if you could unmute and maybe ask in more detail.
Okay, can you hear me?
Yes.
Yep.
Okay, sir, in our fund originally, in talking to Ashley, 90% was to go into our business before the end of the year, the 31st, and leaving the 10%. Then there was a presentation he gave, and I hadn't asked him for clarification yet, but talked about that you could leave a minimal amount in your fund and move more into your business if you wanted to. But then it was also mentioned about that the members of our LLC, each one would have to contribute a 1%. We contribute that into our business, or do we deposit that into our fund?
Okay, I'll try to answer it from what I think I'm hearing, and maybe Gordon or Brett can also answer from what they're hearing. A qualified opportunity fund, in order to avoid any penalties for lack of compliance, 90% or more must be invested into qualified opportunity zone property, which could include real estate or securities issued by corporations and partnerships. So that hurdle has to be 90% or better in the average of June 30th and December 31st in each tax year. If you fail that 90% tax, presently you do not become decertified as an opportunity zone fund. You just pay the penalties. Now the penalties are not very significant. I think the current IRS rate is like 5% per year. And so you can do the math of what's the cost of failing that 90% hurdle and see if it's acceptable or affordable by the investors in the fund. So the bad asset pool is cash and other things that cannot exceed 10%. And so, you know, you're trying to stay above 90 and below 10 on the bad assets. But it doesn't, the fund doesn't get into tax trouble so long as it pays its fines. Gordon, you want to take a shot at this?
You know, that this question comes up occasionally, particularly where you know, there's a development project taking place and there's not you know, 100% certainty with what the cost is going to be, where there might be cost overruns. And so, you know, how do you fund cost overruns? And so, you know, raising extra money that you hold at the fund level that you could put down to the business if it needs it to cover cost overruns and contingencies is one of the strategies that people use. And you know, there's different, different alternatives there. But Paul kind of outlined it that, you know, the most you want to leave at the fund level is 10%, but you don't have to leave anything at the fund level. You could push 100% of your of the money that the fund raises down to the qualified business. Now the fund may have, you know, annual expenses like tax returns, things like that it might need to pay for some costs. So it, you know, it probably makes sense to have some amount of money there, but there's really, you know, there's really no requirement that you have anything there other than just be able to, you know, pay whatever bills the fund's going to have, that, you know, to the extent that there's no cash distributions coming from the operating business or the qualified business to pay for those costs.
And keep in mind that, as I said earlier, it's an average of June 30th and December 31st. And so if you're running very, very low on June 30th, let's say you're running at the 70% level, well, there's no math that's going to allow you to hurdle 90% if you're running at 70% on June 30th. So I advise clients that run funds, I say, do your math every single month, because, you know, you don't want to be pinched at the end of the year and realize that there's no way mathematically to pass the hurdle. So, you know, good practice would be to do your 90% testing every month and make adjustments along the way if you can.
Hey, this is Brett. I just I shared a screen that kind of outlined what the test is, the 90% test and the penalties. I don't know if that's helpful or not, but I would just add, I thought I heard something about a 99% and a 1%, which sounds to me like, you know, what stake should the sponsor have at the QOZB level? And I think that it might be a little bit of a misconception. I mean, you can have as little as 0.01% in the QOZB, and the fund can own 99.99% of the lower tier QOZB. And as Gordon said, I mean, you can have all of the money drop down into that QOZB, and that's typically what our clients do. There really shouldn't be that much left to do at the fund level, especially if it's a single asset fund. I mean, there are going to be some ongoing expenses over time, administrative wise. But, you know, I think it's important to understand that as long as you have this two-tier structure in place, ideally from the get-go, that you've got the 31-month working capital safe harbor. And it would frankly be foolish to do it any other way if it's, especially if it's a new construction deal, because those take time.
Brett, could you maybe show that screen one more
Yeah,
time?
let me share that again. Sorry. This was just, can you see it? Here it is.
Yeah, there we go.
Yeah, so this kind of outlines the penalties that that Paul was talking about earlier. And,
Gotcha.
I've got another slide here that might, I think I have it in this deck. Sort of walks through That's a different one, but yeah, this is a nice kind of visual of the penalties. But I guess my point was, ideally you have a two-tier structure in place so that you're not really subject to this. Ideally, at least in the first 2.5 years, while you're raising funds and trying to get your deal together.
Yeah, one thing to keep in mind too is how do you calculate the value of your investment in the business? So let's say the fund raises $1 million and it contributes 900,000 down to the business and holds 100,000. Well, if you continue to hold 100,000, you have to make sure that the value of the business is going to stay at least 900,000 in order, to pass the 90% test. And I just want to point out that the tax law or the regulations say that the business is valued. Well, there's two different valuation methods. There's an applicable financial statement valuation method, which is only available if you have audited financial statements. So, but even if you do have audited financial statements, my understanding is you can elect to use the alternative valuation method, and under that scenario, the investment is valued at your unadjusted cost basis of the investment. So, in my example, I believe that would mean the 900,000 that you contributed down to that business. And there's some kind of nuanced questions as to like, well, what if you receive distributions from the business? Does that reduce your unadjusted cost basis investment in the business? That unfortunately, that's not clear right now. And I would probably argue that it doesn't, as long as those distributions are just coming from operations. But if you did some sort of a debt finance distribution at the business level where you borrowed money and distributed part of it up to the qualified opportunity fund, there's at least an argument that would reduce your investment value, and therefore that could cause you to fail the 90% test. So you do want to pay attention to what if any items might adjust your basis or your valuation after your initial investment, but generally speaking, unless there's something unusual happening, you probably get to use the 900,000 in my example as your valuation for your subsequent tests. But you do want to look and see if there's anything that might change that.
Brett, thanks for the visuals. Those are really helpful. And if at any point it's appropriate, feel free to share some slides, in the compliance zone, and we can all make comments or notes. I mean, I sit on here and I listen, and I inevitably have a whole list of questions written down even after the questions get asked. But it's great. It gets all of us thinking, and this collaboration is what it's all about. So I know we're right up on time. Paul, Brett, Gordon, any kind of final parting words before we circle back for next month?
We all want to wish all our members happy holidays and a safe and happy, prosperous holiday season and new year. I think, what is it, Chris? We'll be back here on the first Monday of January. We're going to be struggling back here, right? It comes early and fast, but you can always reach all of us on Q&A at the compliance zone, and we'll be watching Q&A and try to provide answers as we see those questions pop up for the remainder of the year. Go ahead.
Absolutely. I know Mary just asked again if we have additional questions. Mary, you can post those. There's a group inside of the platform. So when you log in, go to groups, and you can go to the compliance zone, opt in, and ask questions there. Paul and Gordon and Brett are also monitoring those questions. We will do a session on January 3rd. Who knows how many people will be here, but we will do it. And just continue the dialogue. So if anybody has thoughts or questions in the meantime, please feel free, chime in that compliance zone, and or reach out to these guys directly. And I mean, at some point, ultimately, you can only answer so many questions in these amounts of time. And there's also things that, would be more appropriate with an agreement set up. So that is appropriate when you get to that point, and these guys will let you know when that time is appropriate to work into an official agreement with them. But for now, appreciate you all for being here.
Chris, can I just jump in and make a quick plug?
Yeah, absolutely. Francis?
Yeah.
what's up?
So yeah, I just wanted to let everyone know that we're also having a crypto compliance event tomorrow at 1 p.m. So if anyone is thinking about integrating crypto into their OZ strategy, be sure and jump on and join us tomorrow at 1 p.m.
Thanks, Francis. And
1 p.m.
Francis just
Eastern.
Francis sent me a message saying that he has some like incredible thing that's going to blow
We got
everybody's mind.
exciting
So
stuff,
there's
yeah.
the teaser.
Mm.
Thank you all for participating. Really appreciate you. We'll see you soon, and have a blessed week.